As seen with the examples so far, fibs are certainly a useful analysis method that can be quite reliable and accurate given the proper confirmation and sufficient information on the chart. However, don't hold the perspective of fibs being perfect. This can lead to false confidence if the limitations of fibs are not understood. Now let's go over some limitations of fibs, some of which have already been discussed. Fibs lose reliability as they approach and eventually pass the end of their effective time range. A significant drop in reliability occurs after price has passed the end of the effective time range marked by the length of the trend line that forms the confirmation triangle. Second, fib reliability can drop significantly after price moves past the price range of a fib marked between the 0 and 1 levels. Next, larger fibs are less precise. They tend to miss smaller reversal areas and are less exact with the reversal levels they identify. This is especially true when fibs cover a time frame of 2 years or more, and a price range of 30% or more. Generally, large fibs are best used to gauge long-term trends and identify an approximate area where major reversals are more likely to occur. Large fibs, especially when combined with small fibs, are best suited for identifying large reversals and trends, rather than small short-term price movements. Fibs are also less reliable in the shorter intraday time frame, mainly due to the higher volatility associated with intraday price movements. As well, trading activity and volume, when volume is present on the chart, is not distributed as evenly as on the daily time frame. Often the bulk of trading volume and large price movements happen at the open and close in the case of the stock market. Even when none of the previous characteristics outlined are present, it is important to remember fibs are just guides and approximations of price movement. As mentioned before, nothing is a complete guarantee, and fibs are no different. Even under ideal circumstances, fibs still have the possibility to be wrong. If fibs are not wrong, there is also the greater chance of misunderstanding and misinterpretation. Though not mentioned earlier, you may have already noticed on some charts you could be waiting a very long time for price to form enough reversal points to draw a fib with a confirmation triangle. In some cases, appropriate reversals from which to reference and draw a valid fib just takes time to form. Lots and lots of time. Further limitations can arise due to the reliance and need to reference in order to draw a valid fib. The name Fibonacci retracement inherently implies the past. The in retracement in the context of price charts means future price movements will follow a path influenced by past price movements and behavior. This does not mean price will necessarily copy the exact course of the past and reverse or stall exactly at the fib levels identified. Rather, fibs are severely restricted or completely unreliable when price moves into new all-time highs or new all-time lows. In such situations, price literally enters uncharted territory, and fibs can't be used. Since this class specifically focuses on Fibonacci retracements, to be more specific, the numbers between 1 and 0, all analysis is limited to charts where price has not reached new historic lows or highs. There are certainly other methods of predicting and forecasting price behavior when a chart enters new all-time lows or highs. Some of these methods are based on Fibonacci principles. However, that is beyond the scope of this class.